All right, so even though numerous investment options are available in the national market, many Indians are now exploring international properties. But what are the do's and don'ts for buying a property abroad? How can a resident Indian and non-resident Indian buy real estate abroad? And what does RBI guidelines say about purchasing a property outside India? Let's answer all of these questions. And I have Anuj Puri, Chairman Anurag Group, and Anil Rego, Founder, CEO, Right Horizons, with me today. Anuj and Anil, good evening and welcome to the show. Anuj, I'll come to you first because I really want to know what are those locations abroad that Indians want to go ahead and buy real estate at, and usually is it a big trend, or you think it's just a one-off thing that we are seeing right now?
First of all, Kavita, it's always a delight to be on your show, and good evening to all your viewers. So it is a very increasing phenomena that we are discovering by high net worth individuals to buy real estate overseas. Some of the most attractive locations are London, Canada, Dubai, and Portugal. And various reasons for that, Kavita, is whether it is that the kids are studying abroad and they want to buy property for the kids to be able to live in there, whether it's a status symbol, whether it's investment that they're doing. Majority of them are buying it because they are able to get permanent residency. So, for example, in Portugal, if you were to buy a property above a certain limit, or in Dubai, you do get permanent residency in those countries. The most popular that I would say is amongst all the jurisdictions that I enumerated is Dubai. It has really become very hot at this moment in time for a number of Indians to buy real estate under the liberalized remittance scheme in Dubai.
Exactly. I'm going to go deeper in terms of financial planning aspect of buying these properties abroad, and also what kind of properties are people buying. But then before that, Anil, let's also get into the legal aspect of this entire situation. What's been the rule and law so far, and what's changed? How can an Indian buy real estate abroad?
Yeah, today actually it's reasonably liberalized in terms of for an Indian to buy property overseas. The limit also is reasonable, as per the liberalized remittance scheme, or the LRS. Basically, up to $250,000 per person per year, you can use this money to buy property, overseas. So that's sort of the key regulation, which sort of allows you to go and invest in property overseas. Now, you can also get it, let's say, through an inheritance, or if NRIs are there who have sort of returned back to India, you can use a resident foreign currency account. If you are an NRI and you're still overseas, then you can buy a property from the proceeds which you have earned externally. Okay, and it's been a little liberalized, and there's a lot of things that you can do today, including jointly, you can buy with a relative. Okay, and so today, for somebody who's looking to buy a property, you need not only buy it in India, you can also go overseas and say husband and wife together, for example, $500,000 is something that, you can easily do it in a year. And if not, you can, over a combination of multiple years, you can end up transferring money and sort of buying a property.
Exactly, because when you talk about financial planning and when we talk about diversifying your portfolio across asset classes, this can be really a fantastic option. So Anuj, let's help our viewers buy a property in London, Canada, Portugal, Dubai. Okay, these 4 markets we're going to focus on, and you are going to tell me the property rates over there and what kind of real estate are actually Indians preferring in these markets.
So Kavita, majority of the inquiries that we're getting is in the range. For Dubai, it's probably the least. So it's about $500,000, which is, I would say, about 3.5 to 4 crore rupees. That is where majority of the buyers are looking to get into that market from India into Dubai. As you get into Canada, Singapore, and Dubai, it goes up to $1 million, which is about 8 crores and above. 8 to 10 crores is where the sweet spot is. But Dubai is the least. And in that comparison, Portugal comes somewhere in between Dubai and London or Canada at about 5.5, 6 crores. So that is what the range is. We've also started to see now in Dubai, people wanting to buy properties of 1.5, 2 crores as well. And fortunately, Kavita, there are a number of very good quality developers who are developing properties in that range in Dubai, and a lot of it is really catered towards the Indians who are looking to buy property in Dubai from India. Also, it's quite easy, 2.5, 3 hour flight from Bombay. It's also a status symbol. People are wanting to go there for holidays. Dubai, that way, has become quite an interesting destination. And as I said, apart from investment, diversified investment, it's also become a status symbol in there. So I would say is a lot of that inquiry that we are getting in is largely for Dubai, but the other ones, Canada and London, more from sort of kids' education, or these are really ultra high net worth individuals who want to relocate in those markets. And then Portugal, because of the permanent residency that you get if you were to buy a property there.
Talk about law and rules and regulations, Anuj. How investor friendly are these markets? I think you highlighted a couple of things for Dubai because they are really attracting Indians and they are coming up with schemes and offers. But then what about the other markets?
So Portugal is very similar to Dubai, where you do get a permanent residency, and if you live there for long enough, you do get the passport, and clearly it is a European Union passport, so you are able to get into the EU countries through that passport. So that's pretty simple, just like where Dubai is. Some of the other markets are a little bit more challenging as far as the legality is concerned. I wouldn't say challenging, it's a little bit more tedious than if you were to invest in Dubai and Portugal, London, Canada, and Singapore. But you do get the ability to be able to get mortgage in these markets and be able to sort of raise debt in there. One thing good about these markets, Kavita, is that ability to buy good quality residential in the secondary market is very much available for those investors who are going into these markets.
Now, Anil, the financial planning part of this, can buying real estate abroad can be your financial goal, just like the one you want to do it in India? A lot of us grew up with this dream, okay? We save, invest a lot of money for it, and also while going ahead, we take a loan to buy a house. Can all this be done when you want to buy a property abroad?
Yeah, definitely. I think that is, a goal that somebody can have. However, I think you need to look at all the aspects, surrounding it. For example, if you buy it overseas, you're probably, buying it for, citizenship, or you're probably looking at it for an investment. You today have rental yield opportunities which are there. Or maybe, your children are there, and, so there'll probably be a reason or the other, because along with, let's say, buying the property, if you want to plan to stay there, then, you need to think of how you're going to go about its citizenship and, the other aspects of migration, right? So that is something that one looks at various constraints. But yes, once you're clear and you have the reasons for doing it, then you say, okay, this is my goal. First of all, you'll have to start coming back and saying, what is the amount that I need to plan for? What is the time frame? If it's a longer period of time, then, you can build it up over a period of time. If you want to build up something for your children or for immigration purposes, etc., then that is something which, you can plan within that time frame. Then it comes back to saying, what do I have right now? What is the gap? And go about doing a financial plan in it. See, typically, when would somebody do it? You would do it if you're probably in the ultra HNI category, right? So you already have your properties in India, you have assets, there is surplus, and then you start looking at maybe even diversifying real estate beyond India. Okay, then you would sort of make it happen, and maybe a residency, is something that you may be wanting to look at either for yourself or your children, right? So there, it definitely is sort of thing to consider. And once one does the plan, okay, then it's about how do you get towards execution and looking at all the nitty-gritties and possibly the of buying the property as well as remitting the money overseas.
Anil, also, what would be the tax implications?
See, when you're buying a property, there's no tax implication. but actually when you sell it, then it will sort of be treated as capital gains. Okay, again at that point of time, one doesn't know whether you're in India, not in India, and you're a resident of India, etc. But it will be a non-real estate thing, assuming that you also sell it while you are sort of an Indian resident. So the rules will be sort of similar to what it is for somebody who's buying and selling a property in India from a capital gains standpoint.
Sure. Anuj, first of all, what kind of tax implication? I think I've just asked this question to Anil, but then to you, can Indians have rental income with this kind of property abroad? And how do you think people who have lived all their life abroad come back to India and then rent out those properties? Do you see this kind of trend coming up as well, Anuj?
Certainly, Kavita, rental yields in India, Kavita, are about, for residential, is about 2%. In many of these jurisdictions, the rental yields are very attractive. Dubai, you can get up to 6-7%. In UK, you can get up to 4.5-5% or 4%, I would say. So, far greater than what you would be able to get in India. Can you earn rental on these assets? Absolutely. Can you bring it to India? Absolutely. No problem on that. But very attractive yields in comparison to Indian residential yields.
Sure. All right, so I think that will be all, and these are the nitty-gritties involved if at all you are someone who's looking for further diversification in your real estate portfolio, and that is a property abroad. Thank you so much, Anil and Anuj, for being on the show and helping our viewers with this. On that note, we'll take a quick break, and post that, let's talk about green deposits. Now, when we already have fixed deposits, and that's been one of the favorite traditional investment category for most of Indians, what exactly is green deposit? Let's understand all of this after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and effective June 1st, banks that accept green deposit will have to inform the Reserve Bank of India how they would invest the funds collected under green deposit. Now, the move is aimed at enhancing transparency and ensuring that the money goes to its intended cause. But what exactly are green deposits and how are they different from regular fixed deposits? Let's understand all of this. I have Mrin Agrawal, founder director of FinSafe, with me. Mrin, good evening. Welcome to the show. We already love fixed deposits in India, okay? And looking at the interest rate rise also, we've seen a lot of benefit going or being passed on to these to Indians who specifically prefer very secured, safe and very conservative form of investment for them. But what exactly are green deposit? How similar and how different are they from your regular fixed deposit?
So good evening, Kavita, and it's lovely to be on your show. Well, the green deposit works just like a normal fixed deposit. So it's a fixed amount invested at a fixed interest rate for a fixed period, except that the usage of the deposit is going to be different. Banks need to use it to basically fund green projects and activities. So unlike the normal deposits, which can be lent out for any business, these deposits need to be used for specific activities, which are actually outlined by the United Nations Sustainable Development Goals. So these would include things like renewable energy, climate change, green transportation, waste management. So essentially, this money would need to go towards funding projects in this space, like, for example, pollution prevention or biodiversity conservation, etc. And as you just mentioned, that the new rule is that banks would need to inform as to where the funds are being invested. There's also going to be a third-party verification on the usage of the fund and an impact analysis on the utilization of these funds as well.
Mrin, just to get a perspective and to understand, how does this thing work globally? Is it a global phenomena?
Yes, it is. There are some banks globally who are offering it as well. And of course, this ties in with the whole thing that you're seeing around ESG.
All right. So the kind of projects that these banks or other financial institutions would be funding, on what basis would that criteria be decided to fund a particular project? Is there a guideline or a framework decided by the central bank for this? Because if I'm putting my money in a particular green deposit and I know that this bank is using this money for a particular project, won't an investor want to know about it? Is it possible? Is there transparency when it comes to know what kind of project your particular bank is funding through this money that you have put in? Marin, am I audible? Marin, are you able to hear me? Okay, I think we are going to get back to her. But then before that, just because we also discussed what kind of banks are offering this facility of green deposits. So just to name a few, we have Federal Bank, IndusInd Bank, HSBC, we have Union Bank, we have DBS Bank and HDFC Bank and Citibank, who already offer this service of green deposit in India as well. Also, very important part is the rate of interest that you can earn. So just like we've discussed earlier, green deposit are just like your regular fixed deposit. The rate could be just 0.5% higher as compared to your regular fixed deposit. I also have Mrin back with me. Mrin, did you get the question or you want me to repeat?
Yeah, can you just repeat it, please?
Sure. So I was just trying to understand that so these banks and financial institutions obviously have to fund a particular project with the kind of money the investor puts into a green deposit. So what would be the criteria of selecting and deciding these projects from a bank's perspective? And also, if I am putting my money in this particular green deposit, will there be transparency for me to know as to what kind of a project this bank is funding from my money?
I think, we'll have to wait for some of these guidelines to be developed. Yes, RBI has certainly come out and said that banks have to frame guidelines in terms of what sort of projects they are funding. And hopefully in the future, we would be able to see it. I'm not sure whether we'd be able to see the exact details of the project funded. I don't know how much transparency will be there on that front. That we have to wait and watch.
All right. And what kind of investment duration are we talking about? What's the interest rate that we are talking about? Is it totally similar to your fixed deposit that you already have?
From what I saw, it's typically about 0.5% more. And the investment duration, what I saw was typically in the range of about 3 to 6 years that is available. So somebody had 111 days, 222 days. Some people had like 36 to 60 months. So I think typically in the range of about 3 to 6 years is what we are looking at. And I think, for example, a regular deposit would give you about maybe 7%, and this could give you about 7.55%, of course, depending on a higher time frame. So, of course, each bank has its own different interest rates, but I think what we are looking at is about 0.5% over the regular deposit.
Also, Umrin, our deposits in the bank are insured. And I think almost around by till 5 lakh, you get that insured money if at all something happens to your deposit in a particular bank. Are green deposits also insured?
Yes, very much. They're insured up to 5 lakhs under the deposit guarantee insurance. And of course, as I said, it works in the same way as a normal fixed deposit. So you can invest as an individual, you can invest as a corporate, and it just works in the same way.
Implications involved? Including the tax implications involved, Mrin?
Yes, absolutely. The tax implications are also exactly the same. It is, it's most of these are going to be cumulative deposits. So it's the same way. It's basically taxed at slab. At the time of course, I mean, it's taxed at slab. So, the same things would apply in terms of the tax deduction at source and everything.
Right. So in the end, the bigger question or the most important question, should we really go ahead with green deposit, or is it just a new trendy phenomena that people are catching up to, and just because they see a good cause behind it, about which also we need a lot of clarity, we still don't know much about it. So should an investor consider investing or putting their money in a green deposit? Or you think an ESG fund is a better option just because you want to do something good for the environment?
Yeah, I mean, I think it's really meant for people who are very sustainability conscious and who want to ensure that their money is being invested for these particular green causes. So to that extent, I think it's good. But yes, I mean, right now it could just feel at the starting phase, it could just feel like a trend. And also, the interest rate is 0.5% higher. So if you do have a 3 to 6 year time frame, you might think, okay, why not I just put it there, because I'll be able, everything else would be the same. There might be some differences, though, I feel, in the premature withdrawals. I'm not sure, but I think there could be some differences out there. But I would say that this is really meant for people who are sustainability oriented, who believe in the whole ESG thing, and who want to ensure that their money is invested in ESG compliant manner.
All right, that will be all, and everything that one needs to know about a green deposit. Thank you so much, Min, for being on the show and helping our viewers with this today. On that note, let's take a quick break, and post that I'll be joined by Sanjiv Bhasin, who's going to talk about investing during these market times, and also how do you select a company, and based on that company, what kind of a duration you should be putting your money in. All of this and all of this more about the market as well with Sanjiv Bhasin after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. And when it comes to investing, many investors prefer to invest in stocks instead of investing via mutual funds. Now, when you are investing in stocks, you must get the fundamentals of a company right. And this would mean doing a thorough research about companies and the risk and rewards on offers. So how should an ordinary investor pick stocks? What are the criteria that you must analyze before buying a company? And let's answer all of these questions with Sanjiv Bhasin, Director, IIFL Securities. Sanjiv, hi, good evening, and welcome to the show. Today we're going to talk about investing in stocks. So before we establish the ground for that, I want you to help our viewers in understanding what is the difference between a trader and an investor.
Yeah, good evening, Kavita. Good evening to you, to all the viewers of ET Now. So there is a thin line between a trader and an investor. The trader trades the price and the investor buys a business. The trader sells weakness and buys strength. He looks for an opportunity to trade for a few points or a few rupees or a few, percentages. Whereas the investor is putting in his hard-earned money on a spare capital into a business which he understands will generate returns over a period of time. So the thin line is the trader never becomes the investor and the investor never becomes the trader. To correlate that, if you try to trade in Infosys 10 years back, you missed the opportunity of creating the biggest wealth creator. And if you try to invest in a stock like Arcom 20 years back, and you got stuck in the investment as a trader and you didn't book your loss, then you happen to own the worst stock which has been in the last 20 years. So never mix your emotions. The trader trades the price, whereas the investor buys the business or an investment which he holds for a long number of years.
All right. So can we also say that every market movement or market scenario can be a trader's market, but not every market can be an investor's market, or it's just the other way around?
So it depends on your attitude. If you're a trader, then 9:15 to 3:30 is your playground. You can enter, exit, whatever your style of trading is, whether you're a short-term trader, intraday trader, or long-term. And Kavita, there are 3 simple rules for the trader to follow. First is value at risk. What is the amount of value which you have at risk? Because suppose you trade the derivatives, one lot is worth something like 7 to 10 lakhs. Now on that 10 lakh rupees, there is a margin of say 25%. So on 2.5 lakh rupees, you are taking an exposure of 10 lakh. The profit and loss will be on that 10 lakh, whereas your amount is just 1/4 of that. So value at risk is very important. Second is mark to market. Every day in the derivatives, there is a settlement. So you should not be trading in a position which is loss making and where you have to cough off enough mark to market, which can again put you in peril of being over leveraged. Second is mark to market. And third is, what is your hedge? what are you hedged against? Because every day there is volatility in the market. One is the local scenario. Second is if you carry an overnight position, there is global scenarios against which you don't have if you don't have a hedge, meaning if you have not counterbalanced your risk, then again you are, in a wrong position. So these three things are very, very key for a trader. For the investor, it is the scenario of trying to own an asset class. We own 4 asset classes. Everyone owns a roof over his head, which is real estate, fixed income, which manages to beat inflation and generate risk-free return. Third is gold and silver, to which we attribute to the lady of the house. And fourth is stocks. Now, do you own equity as an investment, as a portfolio? And that is an asset class which must be in every portfolio. That is why you are seeing the advent of the retail investor. So all the 4 proportions are for the business, are for the investor, and in what age is his risk profile, he will have exposure to equity. But equity as an investment is a must, because that is how your capital will grow from small amounts into wealth creation.
Well explained, Sanjeev, but then let's focus on the investor part of it. How do you read the market currently for an investor? And in general also, are we closer to the new high, or you think there is, now the market is getting exhausted?
So Kavita, new highs are for the manuals. It's not material whether you saw, how many years, it's 2.5 years when you saw the COVID lows of less than 8,000 and you are back to 18,800. Last year again, or 3 months back, we were at 16,800. So the idea is that you have to be in the market. There is no such thing called timing the market for the investor. The market has to, the investor has to spend time in the market. I think new high is a formality. It may happen in this week or next week. It's just 300 points. It depends how your portfolio is positioned and how much money are you making on new highs. Are you still stuck with some stocks which are far from their highs or are not beating the index? Then you need some guidance, or you need some sort of a rebalancing of portfolio. We think new highs are inevitable, Kavita, even though the market in the short run is definitely overbought. But the macros for India are putting our demographic premium in the best place I have seen in last 33 years. And I think that may continue for the next 20 years. However, there will be the bouts of volatility where markets will see corrections, which is healthy for the short-term players.
Let's talk about picking specific companies now. Looking at the current valuation, what are the specific sectors that you're looking at? And also within those sectors, if one has to pick up a company, what is that fundamental homework that you need to do?
So, Kavita, on sectors, you've seen that banks and autos on numbers are outperforming. Banks because of the sheer credit expansion which is taking place, and the cleansing of balance sheet. The numbers, the NIMs, the net asset returns have been extremely good, and we are seeing credit expand, whether retail or capex on the corporate side. So banks are in a very sweet spot. Plus inflation has been benign, and the RBI has been on hold in the recent rate high policy. Second is autos, which have come back after a 3-year hiatus, and all because that the demand for autos is at a new high, which I have not seen in 10 years, which means that the supply chain disruption, which was an irritant, is starting to ease, and companies are laughing their way to the bank. Third would be input costs like cement, and cement clearly, because I think once we are through the monsoon, they will be able to raise prices, and you've seen housing and the ancillaries do extremely well. So these are 3 very, very strong sectors. And if you have some allocations there, you are doing well. But we think select stocks like select mid caps is where the real money is, because mid cap index is hitting new highs on a daily basis before the index has done that.
Valuations are still attractive in the mid cap and small cap space, Sanjeev?
Yes. So Kavita, you have to have your asset allocation correct. Now, like you asked me, how do you choose or what do you do? Firstly, you have to see the market cap of what you buy. The market cap is the best guide of where your risk reward is. As Warren Buffett said, he said, there is a price for everything. And when the price is in my favor, then you go whole hog in what you want to invest in. Now, in some of the mid caps, we've seen that a lot of the price erosion or the price performance was more to do with greed and fear. And we think that mid caps are offering a very good entry point. Plus, you are playing against the large cap index, which trades at a very high multiple, in the sense, in the emerging market basket, and which seems fairly priced or fairly expensive. So mid caps offer you that value, and that is why you have to go deeper into what you buy, as in the market cap, the promoters, the peer group, the debt, how the cash is utilized, and last but not least, how the peer groups are performing. And in that, you select your basket of stocks which you think have a potential to become from mid to slightly larger and large caps over the next few years.
Sanjeev, just like how we plan our entry in the market, although one should not time the market, but if we leave the entry part aside, how can we time the exit in a particular stock, and how important it is?
Yeah, that's a very good point. Now, that again depends on your horizon, your risk profile, and your return, expectations. So, Kavita, the first thing I must tell investors is trust your mutual fund or trust your relationship manager. I am in a broking firm, so obviously this is our job. Whether it is depending on the amount of corpus you have, whether it is direct investment, investment through equity mutual funds, through PMS, through AIF, there is a whole basket of investments. Now you have to plan your investments in how you want to generate returns and what is your goal. If you have a goal, only then will you be able to achieve your desired objectives. After being in the market for 33, 34 years, I realized the first thing you start off is, because capital is limited, you try and generate a return in your mind which gives you a certain amount of uh, what you expect. Once you generate that return, what I started to do was, since my capital was limited, I took out my capital, but I let the profit remain in the shape of those stocks as an investment. And some of those actually worked wonders, and those investments grew. So to each person is dependent his own style of investing, his expected returns, and when he wants to take home the profit. But periodically, if you are not there for the next 5, 10, 15 years, which is an easy way to say, then when you see that the market is looking frothy, it is always advisable to take home some cash and wait for another rainy day when again you can deploy that.
All right. When we talk about investments, we really try not to strategize our portfolio strategies or our portfolio calls based on near-term events. But then, since you are there with us, I want to understand your take on the RBI policy on the 8th, and also next week the Fed policy. What do you think can be the call taken? The rate pause will be extended, and looking at the global triggers now, how strong are we on our grounds?
So, Kavita, firstly, let me put it on record. Unfortunately or fortunately, the Fed lost credibility. In 21, when inflation was starting to rise, he termed it as being transitory and misread the markets. And then you came all guns blazing when inflation hit sky high at 9.5%, and you raised rates from 0.5 to 5% in the space of 8 months. Then you had your casualties, the SVB Bank, the First Republic Bank, in Europe, Credit Suisse. So all these are short-term measures which created panic as far as the currency, and some of the leveraged banks which misread the market on the interest rate scenarios in the short and the medium term. However, we think inflation is benign, and even in the US now inflation is closer to 4.5%, which means that the Fed this time should be on hold, because I think he's run way ahead of the times and realizes that even though there is a mild recession, you run the risk of some other banks having exposure to a time duration mismatch in asset liabilities. I think the Fed is on hold. On RBI, I definitely think it's a hold, because we've had a benign inflation environment. Secondly, Kavita, crude is not 100, it's not even budging past 70, 75, which means inflationary pressures are going to be much more benign in India. Our capex is doing well, and bond yields are very stable. On the global side, I think most people had predicted Europe to be the elephant in the room. Unfortunately, that didn't happen. They have run into a mild recession, but stock markets being forward looking barometers, all European indices are hitting all time highs. So like I said, don't try and time the markets because markets are smarter than all of us put together. We think that the policy rates are going to be benign, and that could actually trigger some sort of short covering stroke under ownership of stocks as bond yields start to fall.
Otherwise, it's a comfortable scenario for the Indian market. And with that, thank you so much, Sanjiv, for being on the show and helping our viewers. In fact, giving them the checklist of being a smart investor. Thank you so much. We move on and then let's take our viewers' queries on the show. And for that, I have Hemant Ustigi, Wise Invest Private Limited. Hemant, good evening and welcome to the show. I think we have a caller already with us. We have Kiran from Karnataka who wants to ask you a question. Kiran, hi. Good evening. How are you doing today?
I'm doing fine.
Thank you so much for sending us your question. You want to invest 10 lakhs for how many years? What's the investment duration?
It is around 15 years.
15 years. Any specific target attached to this investment?
No, I'm looking for financial freedom.
Financial freedom. This is just one part of your entire investment strategy, or you'll be having other set of investments also, which maybe in the future or right now if you have?
No, I have got investing in equity in around the world, not only in India.
Okay, you're already doing it. All right.
Yeah. But only thing is mutual fund in India, I'm not very much aware of.
All right, not a problem. Thank you so much. You've come at the right place and asking about, knowing about mutual funds from us. Hemant, financial independence and financial freedom, very broad terms, and it definitely means different things to different people. Although we don't have a lot of details about Kiran's lifestyle and the kind of financial freedom he is looking for, the kind of question he sent to us, how can we analyze this particular scenario and how can we strategize it, and so that it means something closer to what Kiran actually wants in life?
Well, Kavita, considering that we don't have much information about where Kiran has been investing, but like he has clarified that he has been investing in different markets and he's aware of what equity is all about, and considering that he has a time horizon of 15 years and he has clarified that. So I think clearly looking at only the time horizon independently, we can definitely recommend that he can go for equity fund, because when you're investing for such a long period, it's very, very important that you kind of try to stay ahead of inflation, and which is what equity can do for you. Now, important thing is that he has a lump sum to invest, and it appears, as of now at least, that it is going to be a one-off investment. So my recommendation would be that to have to adopt the right strategy, because if you're investing, making first-time investment and one-off investment, I think it's never a great idea to invest entire money at one go. So my recommendation would be to kind of, follow a strategy of having a mix of a lump sum investment, maybe 30 to 40% is lump sum, and the rest of it can be invested through systematic transfer plan, which is what can be around, 40 to 60%. And what will happen then is that he can do it over a period of next 3 months by doing fortnightly STP. This will, help him avoiding investing all the money at one particular level. And I'm expecting that, once we have more clarity on what RBI does and inflation comes under control, expect the market to do well, for a couple of years. So looking at that, he can look at equity fund. 3 funds I'm recommending to him: ICICI Pru Large and Mid Cap, Parag Parikh Flexi Cap Fund, which also invests around 18-19% in the US market, and Kotak Emerging Fund. These are the 3 funds I'm recommending. But also, I would like to recommend that if we can keep adding to these funds over a period of time, because I think Indian equity has the potential to give healthy returns over the next 15 years.
All right, Kiran, anything else you want to ask Hemant? Okay, all the best. We move on. We will take Vikram's question, and Vikram says that he has a investment time horizon of 20 years, and he would like to accumulate. All right, he's not given us the corpus, but then the funds that he's investing in are Navi Nifty 50 Index, Kotak Equity Opportunities, Parag Parikh Flexi Cap, Tata Small Cap, and he is ready to step up his SIP by 10%, and the investment duration is 20 years.
Well, I think his current investment is around 29,000, and he has a time horizon of 20 years, long enough time for him to start in equity. And as I mentioned again, when you're investing for such a long period, it's important to invest in an asset class which can help you, beat inflation. So which is where he's investing or he's planning to invest. So and good thing is that he is committed to kind of increase his SIP by 10% every year, which I think every investor who does that over such a longer period, I think the corpus can be much larger. In this case, if I assume annualized return of say 12%, he can expect to build a corpus of 5.5 crore. So I think it's a great strategy. He has time on hand. His fund selection is good. I think it's a mix of there is a passive fund, there are active funds. Only one change I would recommend to him, that he's chosen Tata small cap fund. In my view, I think it's important to choose a fund which has longer term track record and has been doing well consistently, because this segment is the most aggressive segment. My recommendation would be that if you can consider Nippon India small cap fund instead of Tata small cap fund. But I think rest of the funds are fine. And the strategy of investing through SIP and stepping it up by 10% every year, I think it's a great strategy.
Rahul Yadav's question, and he has Parag Parekh Flexi Cap, Murasset Mid Cap, Axis Small Cap, and 3,000 per fund. This investment is for 30 years and 1 lakh lump sum investment in Canara Becco Small Cap, PGI Mid Cap. We don't have a lot of details on this, but then I think he wants to review the funds that he's accumulated.
Well, I think again, he has a time on hand, 30 years. He's investing 9,000 rupees through SIP in 3 funds. And he also has another set of fund, which is a small cap fund and a mid cap fund, where he's invested lump sum rupees of 1 lakh. So in my view, his investment, considering that he's investing 9,000 per month, so not such a large investment that he has to create 2 set of funds. So my recommendation definitely would be that he's doing the right thing by investing in equity, but he should have 1 set of fund instead of having 2 set of funds. I think he needs to consolidate his portfolio. He's invested.
Okay, I think we have lost Hemant, and that was the recommendation coming for our viewer Rahul Yadav. But then on that note, it's also time to sign off, and before I wrap up the show, I'm going to leave you with our WhatsApp number and our email ID, which is flashing on the screen right now. You can send us your portfolio related queries, your set of mutual fund aligned to a particular goal, and we will get this answered by our experts. And this will be a live financial planning session that we have on the show every day with our financial planner expert. On that note, it's a goodbye. Thank you so much for watching today.